Ever wondered how banks make money out of thin air? They literally do. Welcome to the mind-boggling world of banking, where your cash takes on a life of its own. Banks run on a system called fractional reserve banking. Sounds complicated, right? But it's not. In fact, it's pretty simple. Let's break it down. Imagine you walk into a bank and deposit $100. The bank doesn't just sit on that money. Instead, it turns around and lends out a portion of your deposit to someone else, let's say $80. Now here's where it gets interesting. That $80 then gets deposited into another bank, and that bank lends out a portion of that deposit, say $64. This cycle repeats over and over again. Now you might be thinking, wait a minute, isn't that the same money being counted multiple times? And you'd be right. This is how banks create money. In fact, through this process, your original $100 deposit can generate up to $500 in bank loans. Mind-blowing, isn't it? But here's the twist. While banks can create money, they can't create wealth. That's because every loan has to be paid back with interest. And if it isn't, well, that's when things can get a bit messy. But let's not get ahead of ourselves. The important thing to remember is that banks make money by lending out more than they have in their reserves. This is the magic of fractional reserve banking. So the money you borrow from a bank, it didn't exist until you signed the loan agreement. That's the shocking truth about banks. It's a system that's as fascinating as it is complex. And it's the engine that powers our economy. Stay tuned for more eye-opening insights into the world of banking. We're just getting started. Banks are not just vaults full of money, they are active players in the economy. Let's start by understanding the basic functions of a bank. At the simplest level, banks serve as intermediaries, collecting deposits from savers and lending those funds to borrowers. This might seem like a simple transfer, but there's more to it. When you deposit your money into a bank, you're essentially lending it to the bank. The bank then uses your money to fund loans for other customers. In return, the bank pays you interest on your deposit. This is how you earn from savings accounts and time deposits. But how do banks make money from this? Well, the interest rate they charge on loans is typically higher than the one they pay on deposits. This difference, known as the net interest margin, is a primary source of revenue for banks. In addition to this, banks offer a variety of services, from facilitating transactions like payments and transfers to providing financial advice and insurance. These services not only make our lives easier, but also generate fee income for the banks. Another key function of banks is money creation. Yes, you heard it right. When banks provide loans, they are essentially creating new money. This process, known as fractional reserve banking, is fundamental to the functioning of modern economies. But it's not all about making money. Banks also play a crucial role in maintaining the health of the economy. They help regulate the money supply, influencing everything from inflation rates to economic growth. Banks also act as a safety net, providing security for our money and offering insurance against various risks. They are regulated by central banks and other regulatory bodies to ensure they operate in a safe and sound manner, protecting the interests of depositors and the wider economy. In essence, banks are the lifeblood of the economy, circulating money to keep it alive and growing. If banks give out more money than they have, how do they profit? This is a question that keeps many people up at night. The answer is simpler than you might think. Banks, much like other businesses, generate profits by selling something at a higher price than they bought it. But instead of goods, banks deal with money. Let's break it down. Banks make most of their money through a process called financial intermediation. This is just a fancy term for playing the middleman. They take deposits from individuals and businesses, then lend this money out to other individuals and businesses. They're essentially redistributing money from those who have excess to those who need it. Now here's the catch. When you deposit money into a bank, the bank pays you a certain percentage of interest as a thank you for using their services. This is what we call the deposit rate. It's typically pretty low, usually around 1 to 2%. On the other hand, when the bank lends out money, it charges the borrower a higher interest rate. This is known as the loan rate, and it's generally somewhere between 4 and 6%. So how do banks profit? The magic lies in the difference between these two rates. This difference, often referred to as the spread, is what banks take as their earnings. So if a bank pays 2% interest on deposits and charges 5% interest on loans, it will make a 3% profit. It's important to understand that this spread isn't just free money for the banks. They use it to cover their operating expenses, pay their employees, and invest in new technology and services to improve their offerings. Any leftover profits are then distributed to their shareholders as dividends. So there you have it. Banks are kind of like a middleman, making money from the spread between lending and borrowing rates. They're not just hoarding all the money they get. They're actively using it to keep the economy running smoothly and in the process making a tidy profit. Banks are required to have a permanent reserve of money. But why, you may ask? Well, let's dive into this topic and unravel the mystery together. Banks are like the heart of the financial system, pumping money throughout the economy. But to keep that heart beating steadily, banks need to maintain a certain level of reserves. This is known as the reserve requirement. It's a rule set by the central bank, compelling commercial banks to have a minimum amount of cash on hand at all times. Now imagine a bank without a reserve requirement. It could lend out all its deposits, and then what would happen if a bunch of customers came in wanting to withdraw their money? That's right, the bank would go belly up, triggering what's known as a bank run. This is where the reserve requirement comes into play. It acts as a buffer, ensuring banks can meet their obligations and preventing bank runs. But that's not all. The reserve requirement also plays a crucial role in controlling the money supply in the economy. By adjusting this requirement, central banks can influence how much money banks can lend out, and thus control the flow of money in the economy. It's like adjusting the tap to control the water flow, but in this case, the water is money and the tap is the central bank. Moreover, the reserve requirement also instills confidence in the banking system. Knowing that a bank has a safety cushion to fall back on, customers feel more secure about depositing their hard-earned money. It's like an insurance policy for your deposits, safeguarding them against any unforeseen financial turbulence. So, in a nutshell, the reserve requirement is more than just a rule. It's a vital tool that helps ensure financial stability, prevents bank runs, controls the money supply, and instills confidence in the banking system. So, the reserve requirement is like a safety net, protecting both the bank and its customers. It keeps the financial system running smoothly and ensures that banks can always meet their obligations no matter what the economic weather may bring. Central banks are the bank's bank. But what does that mean? Well, let's dive into it. Central banks are a kind of financial institution, but they're not like the bank you and I would stroll into to deposit a paycheck. They're a notch above that, operating on a national or regional level. Firstly, they set the monetary policy. This is the big picture stuff. Controlling the money supply in an economy. They do this by adjusting interest rates and using other financial tools. When the economy is overheating, they might raise interest rates to cool things down, and when the economy is sluggish, they might lower rates to stimulate growth. It's like a thermostat for the economy. Secondly, central banks act as a lender of last resort. This might sound like they're handing out money to anyone who asks, but that's not quite the case. It means that when commercial banks find themselves in a pickle, say, due to a sudden rush of withdrawals or a bad investment gone wrong, the central bank can step in and provide emergency funding. This helps to prevent a full-blown banking crisis, which, trust me, is not a good time for anyone. Lastly, central banks are in charge of regulating commercial banks. They lay down the rules and make sure they're followed. They set standards for how much banks need to hold in reserve, how they can invest their money, and a whole host of other things. Essentially, they keep the banks in check to make sure they're not taking excessive risks that could jeopardize the stability of the financial system. So, to sum it up, central banks have a lot on their plate. They're steering the ship of the economy, throwing life preservers to struggling banks, and keeping an eye on all the other banks to make sure they're behaving themselves. So, central banks are like the watchdogs of the banking system, ensuring its stability and integrity. From checking accounts to mortgages, banks offer a variety of products, but how do they work? Well, let's get into it. First off, let's talk about checking accounts. These are your everyday go-to accounts. You deposit your money, the bank keeps it safe, and you can access it anytime, whether to pay bills or grab a quick coffee. The bank benefits by using your deposited money to fund loans for other customers. In return, they might offer you interest, albeit usually a small amount. Savings accounts, on the other hand, are designed for you to stash away money for a rainy day. They typically offer higher interest rates than checking accounts because the bank expects you to use the money less often, giving them more stability to plan their lending. Now, onto credit cards. These are essentially small loans that you pay back monthly. Banks make money from the interest you pay if you don't clear your balance every month, and also from fees charged to merchants when you use the card. Then we have loans and mortgages. These are larger sums of money that banks lend you, expecting you to pay back over a set period with interest. The interest you pay is where they make their money. Mortgages work similarly, but they're specifically for buying property. If you don't keep up with your payments, the bank has the right to take the property to recover its money. And finally, there are investment products like stocks and bonds. Banks often act as brokers, buying and selling these on your behalf. They make money from the fees they charge for this service. So all these products work together in a cycle. Your deposits fund loans and credit cards, the interest from which feeds back into your account. And the more you use these products, the more opportunities the bank has to earn from fees and interest. So, banking products are tools that help us manage our money and achieve our financial goals. They're not just services, but key players in the financial ecosystem that keep money flowing. So now you know how banks work, how they profit, and why they're so important. We've journeyed through the fascinating world of banking, uncovering the secrets that lie behind those imposing facades. We've explored how banks function, the numerous ways they generate profit, and the critical role they play in our economy. Remember, banks aren't just giant vaults filled with money. They're dynamic institutions, constantly moving and shaking, lending and borrowing, profiting and providing. They keep our economy humming and our businesses booming. We've uncovered that banks are more than just a place to store our hard-earned cash. They're profit-making machines, earning from the interest on loans, fees from various services they offer, and by playing the market with investments. We've also dived into the mysterious realm of the permanent reserve requirement. This requirement ensures that banks always have a safety net, a cushion to fall back on. It's a critical part of the banking system that keeps our money safe and the economy stable, but the world of banking doesn't stop there. There's so much more to learn, so many more layers to peel back, and that's where you come in. Knowledge, as they say, is power. But it's not just about acquiring knowledge, it's about using it, applying it, making it work for you. So take what you've learned today and use it. Use it to make more informed decisions about your money. Use it to navigate the world of banking with confidence. Use it to grow your business, to secure your future. But don't stop there. Keep learning, keep exploring. The world of finance is vast and ever-changing. There's always something new to discover, a new strategy to try, a new trend to follow. So, stay curious, stay informed, and stay ahead of the game. And remember, you're not alone in this journey. We're here to help you navigate the complex world of finance. We're here to provide you with the knowledge and tools you need to succeed. So, let's keep the conversation going. We want to hear from you. What did you find most interesting about today's video? Do you have any questions, any thoughts or insights you'd like to share? And here's a question for you. How will you apply what you've learned today in your personal or business life? We're eager to hear your responses. Before we wrap up, there's one last thing we'd like you to do. If you found this video helpful, informative, or just plain interesting, show us some love. Like this video, subscribe to the Moneymaker Millionaire channel, and share it with your friends, family, and colleagues. Remember, knowledge is power, so use it wisely. And don't forget to leave a comment, answer the question below, like this video, and subscribe to the Moneymaker Millionaire channel. Stay financially savvy.